Good afternoon, everybody. I'm Jackie Unger, and I'm joined today by my colleague, Daniel Figuenick. Thanks for joining us today for our webinar. We will be providing an update on DOT's DBE program for construction contractors. So here's me. I've got my bio up, which you can read through, but my name is Jackie Unger. I'm a partner in PilieroMazza's Government Contracts Practice Group. In addition to helping our clients with matters related to the DBE program, my practice also involves a wide variety of government contracting and general business issues. I help clients with bid protests and size and status protests and advise on FAR and small business regulatory compliance issues. I also draft and review teaming, subcontract, and joint venture agreements and counsel clients when disputes arise with the government or teaming partners. And I also assist clients involved in false claims investigations. So that's a little bit about me. Let's learn a little bit about Daniel.
Good afternoon, everyone. My name is Daniel Figuenick, and as Jackie said, I'm an associate at PilieroMazza in the Government Contracts Group. Currently, my practice touches on a wide range of topics within government contracts, but specifically bid protests, size and status protests, and compliance with all of SBA's small business programs.
Great, thanks, Daniel. So here's my little spiel about PilieroMazza while we've got you as a captive audience. We're a business law firm that serves as a strategic partner to government contractors and commercial businesses across various industries and practice areas. In addition to assisting in all aspects of government contracts, our firm also assists clients in the areas of business and transactions, labor and employment, and litigation and dispute resolution. You can see all these various areas that we help out in. If you're interested in staying up to date on recent developments impacting government contractors as well as commercial businesses generally, I'd recommend that you sign up for our newsletters and blogs and client alerts on recent updates, which you can do at our website, PilieroMazza.com. So check that out when you have a chance. All right, before we dive into the substance of what we want to talk about today, I just want to provide a brief overview of what we'll be discussing. So first, we'll talk about what is the DBE program. We'll talk about how a firm gets certified as a DBE firm. We'll talk about what a firm needs to do to maintain its eligibility. I'll talk about a little bit about some business development opportunities that are available to DBE firms. I also want to touch on prime contractors' obligations in using DBE subcontractors, since the DBE program is relevant to non-DBE firms as well. We'll talk about how DBE participation is counted towards DBE goals. And then we'll conclude with the impacts of recent legislation and DOT's recently proposed rule, which was issued back in July, and it makes a number of major changes to many areas of the DBE program. So we want to talk about some of the most significant potential changes, and we'll do that as we go through the slides today, comparing the proposed changes against what the current requirements are, so you can have a sort of sense of what would be changing there. All right, so starting off, what is the DBE program? So this program, Disadvantaged Business Enterprise Program, which is run by the US Department of Transportation, is a program that started in 1980 with a goal of prohibiting discrimination in the award and performance of DOT-funded contracts. So it's aimed at leveling the playing field by providing firms that are certified as DBEs a fair opportunity to compete for federally funded transportation contracts. This is for projects that are funded with Federal Highway Administration, Federal Aviation Administration, or Federal Transit Administration funds that relate to transportation projects. So these aren't federal projects, though. They're state and local projects that receive this federal funding. So in order to receive this DOT funding for state and local contracts, recipients at the state and local level must develop and implement a DBE program that conforms to DOT federal standards. A general rule or aspirational goal is that not less than 10% of amounts that are made available with these DOT funds shall be expended with DBEs. One other point I want to make is that the FAA maintains a separate DBE program specifically for concessions in airports. That's the Airport Concessionaire DBE program. The AC DBE program uses most of the same standards and regulations, except that it has a higher size standard than for DBE. So we're not really going to get into the AC DBE program today. That could take up a whole nother webinar. So we're going to be focused mostly on DBE, but most of the things that we'll be talking about today do transfer over to the AC DBE program as well. All right, so next I want to talk about the players and their roles. Who are these different participants in the DBE program? Because there's a lot of many different players here. So just to try to make it a little less confusing. So first of all, we have the US Department of Transportation, who is responsible for the DBE program rules on a national level. They also provide oversight of the program being implemented across the states. And they provide enforcement mechanism, and they also handle any appeals from decisions that are made at the state and local level. So the DBE program is unique because it not only deals with regulations applicable to the DBE contractors themselves, but also to the recipients of the federal funding at the state and local level and prime contractors. So the state and local transportation agencies are the ones who are actually doing the certification of DBE firms. They set up their own DBE programs that follow the DOT standards, but may have some of their own unique procedural rules as well. And we'll talk about some of those. They also set DBE participation goals that they try to meet over the course of the year and also on a contract by contract basis. And they do monitoring of prime contractors and DBE firms to make sure that they're in compliance with requirements. And they do a lot of reporting that's obtaining reports from prime contractors and DBE firms, as well as reporting up to DOT about whether they're meeting their goals and in compliance with the recipient's requirements. Prime contractors, their obligation is generally, overarching obligation is to use good faith efforts to use DBE subcontractors, and they must comply with reporting requirements and reporting up to the state and local transportation agencies with whom they're contracting. And then, of course, the DBE firms themselves that have to remain compliant and with the eligibility requirements, and they also have to comply with reporting requirements. So next, we're going to jump into the certification standards. Sorry. Go ahead, Daniel.
You're all right. Thanks, Jackie. So yeah, I'm going to go over some of the certification basics to become a DBE firm. So to be eligible for the DOT's DBE program, an applicant firm must meet the definition for a DBE. It does have a few similarities to the SBA's 8A Business Development Program definition. Specifically, DBEs are for-profit small businesses in which socially and economically disadvantaged individuals own at least a 51% interest and control the management and daily business operations of the firm. So to be considered a small business under the DBE program, firms must meet two size requirements. First, applicants must be small under the applicable NAICS code for the procurement. Firms calculate whether they are under that size standard by taking their average annual gross receipts from the previous 5 fiscal years. Second, applicants must be small under DOT's separate statutory cap. To calculate this, applicants must take their average annual gross receipts from the previous 3 fiscal years and be below $28.48 million. The FFA contracts under the DBE program are slightly different in that they only require firms to be small under the SBA size standard for the applicable procurement, not the DOT's cap. And finally, Federal Highway Administration and Federal Transportation Administration contracts are subject to both standards.
Yeah, so I just want to point out that there's this different yearly time frame that you're looking at depending on whether you're looking at whether you're small under SBA's rules and their size standards, you have to use that 5-year time frame. But for purposes of being small under this ultimate cap, regardless of whether you're small under SBA size standards, you need to use a 3-year time frame for calculating your size under DOT's statutory cap.
Great. So as mentioned previously, the DBE must be both socially and economically disadvantaged. Here, I'm going to discuss briefly what it means to be socially disadvantaged, while Jackie discusses the presumption of economic disadvantage on the next slide. All the groups under the first bullet are presumed to be disadvantaged. Applicants must submit signed, notarized statements indicating that they are a member of the group they claim, as well as demonstrating that they hold themselves out as a member of that group. Generally, DOT follows SBA's designations for disadvantaged groups. However, there is a slight nuance in that SBA's 8A definition does not presume women to be disadvantaged. However, under DOT's DBE program, and as seen under the first bullet, women do fall under that presumption.
And one point here I'd like to make regarding the proposed rule that's recently come out is that the proposed rule establishes a timeline of 5 years that an individual must hold themselves out as belonging to the disadvantaged group. So it's possible for the certifying agency to rebut this presumption of social disadvantage and say that the applicant doesn't fall into that group. And then the applicant would need to show that they've held themselves out as being in that group for a 5-year period. So for instance, a person can't suddenly find out that they have Native American ancestry and then the next day apply for their firm to receive certification. It needs to be, they need to have treated themselves as being a part of that group for what will be 5 years if this proposed rule takes effect. All right, so next is economic disadvantage. So again, with those groups that we had identified on the last slide, those groups are presumed to be socially and economically disadvantaged, but the disadvantaged owner's personal net worth must not exceed 1.32 million. If the personal net worth exceeds that amount, that presumption goes away, and the owner is irrebuttably presumed at that point to not be disadvantaged. So that's really a strict cutoff. If you're above 1.32 million, you will not be considered disadvantaged. The proposed rule seeks to increase this threshold to 1.6 million and increase it every 5 years. So, that's good. It's been some time, I believe, since that threshold has been increased. So that gives more room for growth, whether at the application stage or throughout participation in the program, to allow some accumulation of net worth without needing to get kicked out of the program because net worth has grown so much. However, just having less than that threshold amount, currently 1.32 million, does not mean that the presumption of disadvantage may not be rebutted. Another way that it can be rebutted is if the certifying agency determines that the owner has an ability to accumulate substantial wealth. Currently, the agency is supposed to take a holistic look at the person's financial situation, but the rule identifies certain factors that should be considered in determining whether the individual has that ability to accumulate substantial wealth. And that would include whether their average gross income is more than 350,000 over the last 3 years, whether that amount of income is unusual and not likely to be repeated, whether the earnings are offset by losses, whether the individual's income is reinvested in the firm or used to pay taxes, and also the total fair market value of the individual's assets and whether they exceed $6 million. That's not a strict cutoff, but those are some different factors that the certifying agency generally should be considering. The agency would there's also a 2-year look back asset transfer rule under which assets that are transferred to family members or the applicant firm for less than fair market value within 2 years prior to the application or the annual review will be attributed to the DBE owner and added to their assets, unless the transfer is for essential support or is a customary gift. So you need to be careful in the transfers that are made to family members. So then one thing that is important to point out here with respect to the proposed rule is that it would eliminate any specific factors that would need to be taken into account in determining the ability to accumulate substantial wealth, instead taking a what they call big picture approach. Under this approach, certifiers would evaluate whether a reasonable person would consider the owner to be economically disadvantaged. Some of the indicators that would be taken into consideration might include whether the individual has a ready access to wealth, a lavish lifestyle, income or assets of a type or magnitude inconsistent with economic disadvantage, or other circumstances that economically disadvantaged people typically do not enjoy. So this clearly gives a lot of flexibility to the certifier in terms of taking this holistic view, but there is some concern that it would lead to very subjective judgments by the certifying agency, and could lead to an inconsistent application of the regulation as well when there's no objective guidance or factors that they must be looking at, really, or what they should be looking at. And DOT has recognized that as well in the proposed rule, asking for comments on their alternative test here and whether it's really workable or not. So as I mentioned, there's this personal net worth calculation that must be done at the application and is considered on a yearly basis as well. And the current threshold is 1.32 million. So a couple points in determining that personal net worth amount for the calculation. A few things are excluded that we wanted to point out. So first, the disadvantaged individual's ownership interest in the applicant firm itself is not included. The equity in the owner's primary residence is not included, except for any portion of equity that's attributable to excessive withdrawals from the applicant firm. And any tax and interest penalties that would accrue if retirement savings or investments were distributed at the present time. So generally, retirement accounts, the present value of retirement accounts are included. And here's another area where there would be a change under the proposed rule, because the proposed rule would exclude the full balance of retirement accounts altogether. DOT basically found that it's not worth the administrative hassle of having applicants and certifying agencies have to go through the process of figuring out what that present value should be. Let's just exclude the value of retirement accounts altogether from that calculation. So that would be beneficial to applicants who might be near that threshold amount, that their retirement accounts would no longer be taken into account in any value whatsoever. All right, so next, talk about ownership. To be an eligible DBE, a firm must be at least 51% directly owned by socially and economically disadvantaged individuals. And here we have, the different standards for corporations, LLCs, and partnerships. So for corporations, the current rule is that the disadvantaged owner must own 51% of each class of voting stock and 51% of the aggregate of all stock outstanding. The proposed rule would change this to requiring the disadvantaged owner to own 51% of each class of stock, whether it has voting rights attached to it or not. There's no differentiation there. That's one point I wanted to make. So as we've noted here, the firm generally must be directly owned by the disadvantaged individuals. However, indirect ownership is allowed if the DBE firm is owned and controlled by a parent or holding company that is established for tax, capitalization, or other purposes consistent with industry practice, and the parent company is majority owned and controlled by disadvantaged individuals. So there is some ability there, but there's, this limitation on what type or the purpose of the parent or holding company, Well, the proposed rule would get rid of that language regarding the reasoning for using a parent company and would allow indirect ownership, but only at one tier, one level of indirect ownership. There could only be one level of a parent or holding company, and then above that, the disadvantaged individual would have to own that, majority own the parent or holding company. So the ownership requirements, the ownership must be real, substantial, and continuing, and go beyond pro forma ownership. So under this analysis, the certifier usually will consider the origins of the owner assets used to obtain the firm. The disadvantaged owner's acquisition should generally reflect the normal course of business with documented capital contributions that reflect the ownership percentage. Where there are business interests that are transferred to the disadvantaged individual for less than adequate consideration, they may not actually end up being considered owned by the disadvantaged individual. If the transfer came from a non-disadvantaged individual who remains involved in the firm or any of its affiliates, or is engaged in this ongoing relationship with the firm or affiliate, because the certifying agencies may see that as just transferring the firm in order to get it DBE certified, and may not view that as a real, substantial, and continuing ownership. The owner also must be entitled to profits and losses commensurate with its ownership interest. So any term that would give another owner, a minority owner, or someone else a superior right to the firm's profits over the disadvantaged individual is problematic, and we have seen that come up as a problem raised by certifying agencies sometimes. So one last thing to point out here is that the proposed rule intends to replace the concept of real, substantial, and continuing capital contributions and ownership with a broader, more flexible requirement that transactions affecting ownership must make reasonable economic sense. So, for instance, in terms of acquisition, reasonable economic sense would depend in part on whether the disadvantaged individual has acquired ownership at fair value, or if it was a gift, the transferor should not be involved in the business after the gift is made. And reasonable economic sense would also require that neither disadvantaged individuals nor the non-disadvantaged owners derive benefits or bear burdens that are clearly disproportionate to their ownership shares. So it may not require, perfect capital contribution that aligns perfectly with their ownership share, but it should be generally proportional. DOT noted that there have been denials where there's $1 off from a capital contribution, so it's not directly proportional with the ownership percentage, and that seems to be too strict of a stance. And so DOT is trying to allow a little bit more flexibility here in looking at whether really the way that ownership is formed and held makes economic sense. All right, next slide, we'll talk about demonstrating control. So first of all, only independent businesses can be DBE certified. So it's important under the regulations that a DBE firm's viability not depend on relationships with other firms. So in looking at whether the DBE firm is independent, the certifier will examine an applicant's relationships with non-DBE firms, prime contractors, and present or recent employer-employee relationships between the disadvantaged owner and the potential DBE and non-DBE firms. They just want to make sure, that the DBE firm can stand on its own. So next, the disadvantaged owner needs to be able to, not just be able to, but be in control of day-to-day and long-term decision-making regarding management, policy, and operations. In this regard, to show control, there must be no restriction on the disadvantaged owner's control in the bylaws or governing documents of the company. There must be no agreements that restrict the disadvantaged owner's voting rights, and basically no veto power by other shareholders. As written, the current regulations are very strict in saying that the disadvantaged owner needs to have control basically over all decision making for the firm. Another aspect of control is that, generally speaking, the disadvantaged owner should be full-time devoted to the firm, and outside employment cannot conflict with management and control of the firm. That's not to say that there can't be outside activities and outside employment, but the disadvantaged owner, the firm, needs to be able to document, would have the burden on the firm to document how any outside employment does not prohibit its ability to basically still run the firm. In terms of control, the concept of delegating responsibilities is important. The rules do understand that, generally to run a successful business, you have to be able to delegate certain decision-making, certain operations, and that is okay under the current rules. But the disadvantaged owner needs to still have an understanding of management and have a technical competence relative to the type of business that they're running. They need to be able to intelligently and critically make decisions and take in information that those to whom they delegate certain operations, that they understand they're getting reports from those people and ultimately making decisions based on the information and actions that others are taking on behalf of the company. Currently, it's also important that any licenses and credentials that are required under state law be held by the disadvantaged owner upon whom eligibility is based. So now I want to talk a little bit about the proposed rule, which again offers more flexibility. One of which that I see as having the biggest impact is that the proposed rule would accept some commercially reasonable restrictions in the corporate documents on the disadvantaged owner's power, like voting power and decision-making power. That would only be for extraordinary actions, but in that regard, provisions that would require consent by non-disadvantaged owners would be okay. But really, this is a pretty small umbrella or type of decisions where you can allow veto rights to the minority owners. For example, that could include agreement on or veto rights on the sale of the company or substantially all of its assets, mergers, and the sudden or wholesale change of the type of business. So still, minority owners can't have any say or veto right over day-to-day operations, but it would at least, the proposed rule would align better with basic commercial practices that allow for protection of minority investors and minority owners, to allow them at least limited rights for extraordinary actions. The proposed rule would also clarify that delegation, again, is permissible, as that's customary in the industry, especially as a firm becomes more, grows more and becomes bigger. You might have more delegation, as long as that delegation is revocable and the disadvantaged owner remains the ultimate decision maker and is basically the one who runs the show by having the final say, and that there's no other party who can have equal or greater power than them. And the way that the proposed rule is written, there's just more of a focus on the role of the disadvantaged owner and making sure that they actually have control versus looking at others. For instance, under the current rules, there's quite a bit of focus where if family members are involved in the firm, then a lot of certifying agencies automatically see that as problematic if they're non-disadvantaged family members, because they assume that those family members must be in control of the firm. And so the way that the proposed rule is written would kind of take away from some of that emphasis on non-disadvantaged participants in the firm, and really just look at, does that disadvantaged owner have the ability to control themselves? All right, moving on to the certification process. Daniel, do you want to take this one? Sounds like my lost Daniel. So I will carry on, but Daniel, if you come back, just hop on in again. Okay, next talking about the certification process, moving on from the eligibility standards. So applicants in every state fill out the same unified certification application. This is an application that's developed by the U.S. Department of Transportation, and in which all certifying agencies are required to use. So this, with the intent of providing one-stop shopping, that an applicant is required to apply only once for DBE certification that will be honored by recipients and certifying agencies in the state, because there can be many different certifying agencies within one state. So the applicant needs to fill out this form. They provide supporting documentation relating to the structure and ownership and control of the firm, and its work history, the equipment it owns, its income tax returns, and bonding and financial capability of the firm. Then after all the documentation is provided, the certifying agency will conduct an on-site visit where they will interview the firm's principal place at the firm's principal place of visit and any job sites. They will interview the principal officers to entail a review of resumes and work histories, and they may also interview key personnel as well. One change to this process is that with the pandemic happening, DOT allowed these on-site visits to actually occur virtually, and that's something that the proposed rule intends to make permanent, at least the option for certifying agencies to conduct these visits virtually, because they feel that you can get the same information through these interviews through a virtual interview. Let's see. So the application is supposed to be processed in 90 days, although there's the possibility for an extension. The proposed rule would limit certifying agencies' extension period from 60 days to 30 days, again, attempting to streamline the process a bit more. And then a very important concept in the DBE program is interstate certification. So an applicant must get certified in the state where its principal place of business is located before applying for DBE certification in other states. The certification only applies to projects in the state where you are certified. So if you get certified in one state and then you want to work on a bid on a project in another state, you would first need to get certified in your home state, and then you can apply for interstate certification in those secondary states. When you apply for interstate certification, the certifier in the other state has currently, under the current rules, has the option to accept the home state certification and just go ahead and certify you in the second state, or it can perform a limited analysis of its own. There are certain procedures that must be followed with like documents that have to be shared with the interstate certifier, but basically the second state has to certify the firm unless it has good cause to believe the certification in the home state was erroneous or should not apply. The proposed rule makes a significant change in this area. It would require interstate certifiers to accept the home state certification. It would totally do away with the ability for an interstate certifier to conduct its own limited analysis before certifying a firm that's already been certified in its home state. We've seen, and DOT in its rule commentary on its rule talked about seeing a lot of issues where interstate certifiers are not following proper procedures, are requesting documents that they shouldn't, are conducting a full analysis of eligibility rather than the limited one that they should undertake. And so their certification is being denied for interstate certification when it really shouldn't be. So to, again, ease that administrative burden about what analysis can or should be done, and to make it a faster process for DBE firms that have already gone through the hoops of getting certified in the first state, the proposed rule is requiring or would require interstate certifiers to accept the home state certification. And once they see that the firm has been certified in its home state, they would go ahead and certify within 10 business days. So that would be a much, much, much faster process than we're already dealing with. The interstate certifier would still have the ability after that certification to request records from the home state and to perform its own certification review, but it wouldn't be able to, stop the initial interstate certification. It would get the certification and then it could conduct a review afterwards if it wanted to. All right, can we go to the next slide, please? So next we've got requirements for remaining in the DBE program. So the main one here is that, well, once you're certified, the DBE firm remains certified unless the certifier removes that certification. So you get to keep your certification for life unless there's basically a change in circumstances or a basis to have that certification removed. However, the DBE firm still would need to provide an annual affidavit that there have been no changes in eligibility or other material information in the application, and that the DBE firm continues to meet the size standards and the overall DOT gross receipts cap. They also must provide their tax returns and other documents that the certifying agency may request. In terms of changes in circumstance, there is an obligation for DBE firms to inform the state in writing of changes in circumstance that could affect eligibility within 30 days of the change occurring. A failure to make a timely notification of a change would be deemed as a failure to cooperate, which could result in removal of eligibility. So it's super important to make sure that these changes are being reported to the state certifying agency in a timely manner. Also, a certification review by the certifying agency, including unannounced on-site reviews, can take place in light of changed circumstances or other information that the certifying agency receives regarding a DBE firm's eligibility. Okay, so we have some special rules in the DBE program for native-owned firms, so I just wanted to spend a couple minutes to go over some of those key rules. So first, a firm that is owned by an Indian tribe that's recognized federally or by a state, or a Native Hawaiian-owned organization may be eligible for certification. So for them to be certified, they must still meet the size standards and be controlled by socially and economically disadvantaged individuals. The disadvantaged individuals, who are the ones who must be socially and economically disadvantaged, who are being relied on for the eligibility purposes, they don't necessarily need to be members of the tribe that owns the business. For example, the CEO of a tribally owned business could be Hispanic. They don't have to be a member of that tribe, but they do have to be socially and economically disadvantaged. That means that those disadvantaged individuals who control the firm must meet the personal net worth standards. They have to be economically disadvantaged as well as socially disadvantaged. So they have to be below the personal net worth threshold. This doesn't apply to every member of the Indian tribe. For the tribe that owns the DBE firm, that has to meet the standards or complete a personal net worth statement. It's only the disadvantaged officers, board members, the CEO, whoever it is in the firm that would actually be the one that controls the firm. They would have to submit that information. And another important point for Indian tribes and NHO-owned organizations that are interested in getting DBE certification is with respect to the ability to meet the size standards, because there's a concern about affiliation between the tribe's multiple subsidiaries that it may own. if you're familiar with federal government contracting, there's generally an exception for affiliation from these entities, different subsidiaries that are owned by the tribe. But that rule is not interpreted the same under DOT's DBE guidance, at least. So DOT is supposed to, the regulations provide for them to follow SBA's size standards and rules in interpreting size, but there's some contradicting language in unofficial DBE guidance that indicates that the department interprets its rule to treat firms owned by Indian tribes as entities that will be affiliated with each other unless those entities have a firewall between them or a legally binding mechanism to prevent the firms from accessing the resources of the entity's other businesses. So, you know, I think it is arguable whether that should be the approach that DOT takes if they're required to follow SBA's regulations, but it's important for tribes to be aware of this potential issue with regard to size, you know, if they're interested in having their subsidiaries bid on or become DBE certified. The rules are a little bit different for ANC owned firms. There, if an ANC, basically if the subsidiary owned by the ANC is majority owned by the ANC, whether it's a subsidiary or a joint venture, other entity, it needs to be majority owned by the ANC. And if it's 8A certified, then that's basically it. It's good to go as a DBE. It doesn't need to meet any of the other DBE specific size, ownership, or control requirements. It just needs to submit. It doesn't even have to provide the fill out and submit the uniform certified application. It would just need to submit a letter with proof of its 8A certification. That SBA certification will carry over and be sufficient to get DBE certification. However, if an ANC owned entity doesn't have 8A certification, it can still seek DBE certification by meeting the same criteria as entities owned by Indian tribes and MHOs. So basically, it still needs to meet the size standards and be controlled by socially and economically disadvantaged individuals. Next, I want to talk about a couple business development opportunities that are available to DBE firms that I think that they should know about. So some recipients, under DOT's regulations, recipients have the ability to set up a business development program in which the recipient provides business development training and assistance to DBE firms. The DBE firms must develop a comprehensive business plan identifying their business targets, objectives, and goals, and work towards that over a period of years. This isn't, you know, a federal program. It's run at the state level, so each recipient can set up its own BD program. So you would need to, and they can all, you know, have unique requirements. So a DBE firm would need to look into the state where it's certified to see whether that program is available and see whether they're interested in taking advantage of the assistance and training that might be offered through that program. Another option is for recipient mentor protege programs. Again, you know, not every state or certifying agency may have these programs set up, but it's worth looking into. For the mentor protege program, the proteges must be certified prior to participating, and there must be a written agreement and a written development plan that's approved by the recipient for the mentor protege relationship, where the protege can team with either a DBE for another DBE firm or a non-DBE firm for business development assistance. And in some cases, the training and assistance that's provided by the mentor to the protege may be reimbursable under FTA, FHWA, and FAA programs. So that those are just two options that might exist in your state where you're certified that are worth looking into, whether you're a DBE firm or if you're a prime contractor that works with DBE firms, it could be worth looking into the mentor protege opportunities. Next slide. All right, now I want to turn to prime contractor obligations under the DBE program. So contracts with DBE goals on them for an amount that should be subcontracted to DBE firms may only be awarded to offerors who make good faith efforts to meet those goals. A bidder can meet that requirement by either documenting commitments by DBE firms that are sufficient to meet the goal at the time that they submit their proposal, or by documenting adequate good faith efforts to meet the goal. This means that the bidder must show that they took all necessary and reasonable steps to achieve a DBE goal, which could reasonably be expected to obtain sufficient DBE participation, even if they don't end up being fully successful. So either basically the prime contractor needs to have a DBE firm signed up with proof that they agree to perform on the project, and that needs to be included in the proposal, or the prime contractor needs to document the efforts it's made to find DBE contractors. That can include market research, attendance at matchmaking events, negotiating with DBEs in good faith, efforts to help interested DBEs obtain bonding or financial support lines of credit, or efforts to assist DBEs in obtaining necessary equipment or supplies, for instance. Just promising to use DBEs after contract award does not constitute good faith efforts and wouldn't be sufficient. However, the proposed rule would make a change to that, specifically for design build construction projects. For these projects, DOT recognizes that the scope is not always exactly clear at the time of the proposal. And so it can be much more difficult to identify a DBE subcontractor or what work a DBE subcontractor would be needed for at the time of proposal submission. So to allow more flexibility there, instead, under the proposed rule, the prime contractor would submit a DBE performance plan, which is kind of akin to a subcontracting plan in federal contracting, where outlines the general commitment to use DBEs and good faith efforts that they'll intend to take. And then once the contract is awarded, ongoing monitoring and oversight of the contract would be done by the recipient to evaluate the good faith efforts made by the prime contractor to comply with its DBE performance plan. Another main obligation is to make prompt payment to DBEs within 30 days of receipt of payment from the recipient. Under the proposed rule, so this is a current requirement and can lead to breach of the prime contract if the prime contractor doesn't comply. But there's not generally, DOT is seeing there's not generally a lot of enforcement of this or overview of this by recipients. Instead, they just take action when the DBE subcontractor comes and complains to them, saying that they're not being paid in a timely manner. So the proposed rule would seek to implement affirmative monitoring to make sure that the recipient puts in place some mechanism for being more proactive in making sure that prompt payment happens, and that it flows down to all lower tier subcontractors as well. The proposed rule doesn't outline what that mechanism should be. That would be up to recipients to determine how they're going to be more proactive about that. But it just basically puts out that mandate for there to be more proactive monitoring of prompt payment. We go to the next slide. Prime contractor limitations and the consequences of breach. So a key limitation for prime contractors is that they cannot terminate or substitute DBEs without prior recipient approval. They need approval from the recipient for any changes to the DBE scope of work. That could include if it wants to do the work with its own forces, its own workforce, if it wants to use a non-DBE firm, or even if it wants to substitute one DBE firm with another. It can't just make that determination on its own. It needs approval from the recipient. And that must be only for good cause. That could happen if the DBE firm voluntarily withdraws or fails to execute a subcontract, if the DBE is ineligible to receive DBE credit for the work, or if the DBE firm fails to perform the work in a way that's consistent with what would be expected in the industry. Then, there can be a basis for removing them, but it has to be approved. So this is extra protection for those DBE firms. And, very important for prime contractors to comply with these obligations, because a failure to do so would constitute a material breach, which could result in termination, withholding progress payment, liquidated damages, sanctions, or disqualification from future bidding, because they would be determined to be non-responsible. All right, next I want to turn to the issue of how DBE participation on a contract gets counted. How can a prime contractor and a recipient take credit? DOT wants to make sure that the DBE firm is not just a pass-through and is not being used for its DBE status only. So the first consideration is whether the DBE firm is performing a commercially useful function. That generally means that the DBE firm needs to be responsible for execution of its scope of work itself. The recipient would consider the amount of work that they subcontract, industry practices, whether the amount the firm is paid is commensurate with the work it's actually performing, and the amount of DBE credit that's being claimed, as well as other factors. The DBE firm is presumed not to be performing a commercially useful function if it does not self-perform at least 30% of its scope of work, or if it subcontracts out an amount more than that is normal for the industry, for the type of work that it's performing. So generally you need to keep that in mind, that the DBE firm needs to be performing at least 30% itself, unless it's in an industry where it's normal to subcontract out more than that. So assuming that the DBE firm is performing a commercially useful function, then you can go to the question of how are we counting that work that they're doing? And that would depend on the type of work that's being performed, the type of contract. So for instance, for construction contracts, the portion of work that's performed by the DBE's own forces is counted in determining the credit that can be taken. For contracts with professional, technical, or consultant services, it would be the fee or the commission that's charged by the DBE firm that would be counted towards the amount that you can claim. It's a little bit more complicated for materials and supplies contracts. For those contracts, it depends on the role that the DBE or subcontracts, it would depend on the role that the DBE firm is playing. If they're a manufacturer of the supplies that are being provided, the prime contractor can count 100% of the cost of supplies that are procured. If the DBE firm meets the definition of a regular dealer, then you can count 60% of the cost of supplies. A regular dealer is a firm that owns or operates a store or warehouse in which the materials are kept in stock and regularly sold to the public in the usual course of business. And the firm's principal business is the purchase and sale of those products. For a firm that is a packager, broker, manufacturer's representative, and others who basically expedite transactions but are not regular dealers, you can only count their fee or commission, but not the cost of materials. So one important change that's proposed by the proposed rule here is that they would basically create a new category of suppliers, which would be for distributors. For those DBE distributors, which would basically be DBE firms that have a valid distribution or distributorship agreement and assume risk for the goods that they're supplying, then credit for 40% of the costs, including transportation of those supplies, can be taken. So this would give more credit to drop shippers that qualify as DBE distributors. The proposed rule also would require recipients to be more proactive and to conduct an upfront investigation as to the DBE's rule, whether it is a regular broker, whether it's or a distributor, rather than waiting until after performance. They need to check before the contract award and look into the relationship and the agreement between the parties to determine how, what role they fill and what credit can be taken. One more point is that work that's subcontracted by a DBE to a non-DBE cannot be counted. If it's subcontracted to a DBE, that's okay, but not to a non-DBE. All right, so moving on, we want to talk about some recent legislation. Daniel, are you back with us?
Yep, Jackie, I'm right here.
Okay, you want to take over?
Awesome, perfect, thank you. So yeah, thus far we've been discussing some of the requirements for the DBE program becoming DBE certified. I think in these next few slides, we're going to look at some of the recent and upcoming funding opportunities, as well as some impacts recent legislation has had on the DBE program. So here is the Bipartisan Infrastructure Law, which is also known as the Infrastructure Investment and Jobs Act. It was passed in November of last year and appropriated roughly $1.2 trillion, with $550 billion of that going specifically towards infrastructure projects. It also reauthorized the DBE program and set a 10% DBE goal for all surface transportation projects, public transportation programs, and federal highway funding. Recently, there have been some funding opportunities flowing down from these appropriations. Specifically, the FTA released opportunities worth upwards of $300 million for 3 different ferry boat programs. The FAA announced an additional $1 billion in grants to fund about 90 different projects at airports across the country to improve access, capacity, and energy efficiency at those airports. And finally, the Federal Railroad Administration made about $570 million available to improve rail infrastructure nationwide. Next slide. Great. And so a little bit more recently, the Inflation Reduction Act was passed just a short while ago on August 16th. And it primarily sought to lower prescription drug costs and healthcare costs in order to combat rising inflation. However, tucked away in this act was potential funding for DBE firms. Specifically, $1.2 billion worth of grants are now available to the Federal Highway Administration to invest in economically disadvantaged communities. Any of this funding, administered by state Department of Transportation agencies, will be subject to that 10% DBE goal we've mentioned throughout. Generally, the Act defines these economically disadvantaged communities as those who are economically disadvantaged, underserved, or located in an area of persistent poverty. Thus, based on the funding from the Bipartisan Infrastructure Law, as well as the increased funding under the recent Inflation Reduction Act, transportation and infrastructure-related funding at DBE firms should continue to boom for the foreseeable future.
All right, so I just wanted to recap again on DOT's proposed rule. I know we've talked about different aspects of this as we've gone through, but as we wrap up, I just wanted to touch on this again. The rule was issued on July 21st and comments are due October 31st. There are a variety of areas where DOT seems, truly up in the air about what sort of analysis it wants, with respect to control, for instance. And it seems like there are already, a number of public comments have already been submitted. So, it's important if you want to get a word in about your views on what regulations should be changed or kept the way they are. Note that due date there. It's coming up quickly. In general, the proposed rule does give more flexibility to DBE firms and certifiers with respect to these certification standards and making eligibility determinations. That could be a double-edged sword. It's good to have more flexibility in terms of, like the way that commercial practices work, can vary by industry and the size of the firm. And so it's good to not have those regulations be too strict. But on the other hand, by not having somewhat more objective criteria, it leaves a lot to the subjective determinations of an individual certifier. And that can lead to inconsistent determinations across certifying agencies, across different states, and that can be hard to reconcile. That can also lead to more appeals to DOT, which, part of the proposed rule is, it's clear that they're trying to decrease the amount of appeals that DOT is dealing with. So, we'll have to see how that turns out. But in general, the flexibility to be able to prove that an individual is a true owner and truly does control, that's a positive for DBE firms. The proposed rule does have streamlined certification procedures, and makes it, as we talked about, a lot easier to get interstate certification, which I think is a great thing, and I'm glad to see. There's also an increased emphasis on permitting DBEs to correct deficiencies that pop up either in the application or after they've been certified. If there's a problem, the rules would give more ability to the firm to try to correct those deficiencies before having their certification revoked, which is also positive, because sometimes the firm doesn't really know, for instance, if rules have changed so that they're no longer eligible the way things are, they may not even know about that. So it's positive to give them this opportunity notice of what the error is that needs to be corrected, give them a chance to fix it before revoking that certification. As we've talked about, there are some changes to how, to what credit can be taken for DBE work. And there's also increased and more proactive recipient monitoring of whether and how prime contractors are fulfilling their obligations. And one other point is that there's also a proposed rule to revise the information that's in the uniform DBE directory that each recipient is required to have. Generally, right now, there's not a lot of information about DBE firms in there. I think maybe just their NAICS code and the firm's basic information. The proposed rule would allow DBE firms to choose to provide a lot more information about their capabilities. And if they're able to do that, it could be a really good marketing database that could be helpful to DBE firms to market themselves, as well as for prime contractors to be able to find qualified DBE firms and document their efforts towards making those good faith efforts as they must to find firms that they can work with. So a lot of changes. Is a very big, long proposed rule, and we'll have to see. It'll probably take a number of months before we get a final rule out of the proposed rule that we see, and I wouldn't be surprised if we see a number of changes from what we see in the proposed rule to what's in the final rule itself, based on the commentary that DOT reviews and takes into account. So next slide. So wrapping up here, I know we're a few minutes over, I apologize for that, but just what to look out for next. So, as Daniel spoke to, look out for new infrastructure opportunities being released by state DOTs over the next few years, and local agencies as well. A lot of funding that's being dedicated to this. So those opportunities are there. You just got to find a way to take advantage of them. And that should continue for several years. Small disadvantaged businesses should consider applying for DBE certification. If you're already certified, consider the business development opportunities, the programs that your recipients may be running. You can also look into interstate certification if you have the wherewithal to look for opportunities in other states, especially after the proposed rule, if it takes effect with respect to interstate certification. It should be much easier to do that. Large businesses also need to familiarize themselves with the DBE requirements, specifically with prime contractor obligations. By the way, those prime contractor obligations also apply to DBE firms that are prime contractors, not just large businesses, because DBE firms can be prime contractor or subcontractor. And large businesses, given all of this funding that's going into these DBE opportunities, large firms, need to pay attention to that and can take advantage of that by teaming with potential DBE partners. And as we've mentioned, the proposed rule will have significant changes to the DBE landscape. So, I highly recommend that you pay attention to what those proposed changes are, look into that further, and pay attention. We'll of course have a client alert that comes out when the final rule comes out, so we'll keep you all posted on what those actual effects are down the road once we get there. So wrapping up, I know that's a lot of information that we packed into a pretty short amount of time, and we're already over here. I should have mentioned at the beginning that there's a chat box here, or a questions box, where you can input any questions. I don't see anything having come in so far, but we have our contact information up here. So please feel free to reach out to us if you have any questions about the information that we've talked about today, or if you have any other questions related to the DBE program. We'd be happy to assist you. So please feel free to reach out. And thanks everybody for joining us today. And thank you, Daniel, as well.
Yes, thank you all.